Hey everyone, me Kevin here. There's a lot of misinformation over what's actually going to cause a housing market crash. In this video, I'm going to go argument by argument and provide facts to justify my response. Full disclaimer, I'm a real estate investor and personally own over 16 million in real estate without partners. I invest heavily in real estate in both multifamily and single-family real estate, and I owe it to myself to be extremely in tune with the real estate market. And if you're interested in building wealth in real estate as well, then you should pay attention to the signals that matter when it comes to a potential shift in the real estate market. Now, in the first half of this video, I'm going to talk about what's not going to cause a housing market crash, and I'll give arguments and facts as to why I believe that. Then in the second half of the video, I'll talk about what is most likely to cause a housing market crash. Quick note, for those of you looking for inexpensive real estate or below market value deals or even off-market deals, I recently partnered with Deal Machine. They're a really neat app that lets you automate your follow-up to fixer-uppers or properties that you identify to help you get in touch with the sellers of these deals. I'm going to start using this a lot over the next couple years, and the market has gotten so competitive that I'm looking for every opportunity to increase my competitiveness. And for the price, this should be a really good value. Check out the link down below. You'll get some extra credits and a free trial for Deal Machine. Okay, let's get started. First, it's all common. It's very, very common to see individuals, especially on YouTube, fearmonger and post charts and say, oh, look, housing prices are high. Look at the Case-Shiller index. This is what housing prices were in '08, and this is what housing prices were now or are now. And there's a lot of this misinformation that, oh my gosh, just because the chart is a little higher now, that for some reason the housing market is destined to crash, because I guess we can never net an upward trajectory of growth. But the problem with this first argument of just throwing up a chart and saying this is what prices were in the past, this is what they are now, is that they don't compare to what interest rates have been. And see, the reality is over the last 13 years, interest rates have fallen down. And we already know the rule of 10x. The rule of 10x says for every 1% that interest rates go down, prices go up 10%. So it's only natural that over the last 13 years, we've seen interest rates decline in a steady trend, that we'll also see housing prices go up in a steady trend. Now, that's not suggesting that, real estate should be propped up by cheap money. I'm just suggesting that it is what it is. When interest rates go down, prices go up, and it's important to kind of ignore the sensationalism that goes around, okay, hey, look, prices are going up, chart's going up, that's bad, it must mean it's gonna come down soon. That's not really a factual way to analyze whether or not the market's going to decline. We'll talk about factual ways to analyze whether or not the market's going to decline very shortly. But first, another thing that a lot of individuals are doing now is they're talking about mortgage delinquencies. Most of these doom and gloom videos that exist on YouTube suggest that the housing market will have a serious crash because of, quote, serious housing delinquencies that are now through the roof, they say, that more than 2 million homeowners are seriously delinquent. Well, here's the reality. Yes, it's true. According to analytics company Black Knight, total delinquencies might be down 9% and trending down, but serious delinquencies of people not making their payments over the last 90 days are up 5%. So you've got total delinquencies going down, but it is true that serious delinquencies are trending up. And so doom and gloomers say, that's it. This is all the proof we need. We've got the charts going up and, serious delinquencies are going up. That's it. That's all we need. Now we're gonna have a crash. But let's be real here. 3.4 million mortgages, about 6.87% of all mortgages, are taking forbearance plans. This allows people to prevent making their payments for up to 1 year for any reason. You don't even need a reason. You just raise your hand and say, I'd like to take mortgage forbearance. It's literally free money because, as we know, if you don't pay money for 15 or 30 years, well, then that basically becomes free money if you invest the difference. But the actual reality that we should pay attention to is the fact that many of these seriously delinquent homeowners might not actually need forbearance. That is, they might optionally be taking this as a form of additional stimulus. Now, this isn't to say that there aren't people who actually need mortgage forbearance. But the reality is anyone taking mortgage forbearance right now has a beautiful opportunity to prevent foreclosure, has a beautiful opportunity to build an emergency fund and insulate themselves from future foreclosure issues. And even at the end of a forbearance period, in most cases, you could take the money that you owe and add it to the back of the loan. In other cases, you're able to take advantage of things like loan modifications or other deferment plans to prevent going into foreclosure. But to point at a statistic of mortgage delinquencies and say, oh my gosh, serious delinquencies are up, that's it, housing is screwed, No, it's doom and gloom, and it's misleading. Until there's actual data that says, okay, here are 3.4 million people in forbearance and 1 million actually need it, or else they're going into foreclosure, then delinquencies mean nothing for us, while mortgage forbearance is possible. And frankly, we might never have the actual data that says, okay, here are the actual people who need forbearance, and here are those who are just taking it because it's basically free money. And the fact of the matter is, on this channel, I've recommended people take mortgage forbearance. I say all the time, go to metkevin.com/forbearance and learn how to take mortgage forbearance in the proper way and not get screwed by banks. And the reality is, when you look at the CARES Act, the law allows you to take mortgage forbearance with no documentation and no proof of income or no proof of hardship. You just ask. And so, to me, when doom and gloomers say, that's it, this is clear information that a foreclosure crisis is imminent, delinquencies are so high, they've never been this high, it's a total misrepresentation of the facts. Now, understanding home equity also becomes very important here. CoreLogic reports that in quarter 2 of 2020, by the way, I will link all of my sources down below. In quarter 2, 2020, homeowner equity shot up 6.5%, and negative equity fell 15%. And CoreLogic reports that if prices today all of a sudden dropped 15%, 8% of people would be underwater. Now, that's it. 92% of people would be above water. They'd have more equity in their home despite a 15% decline in prices. It helps that real estate prices are trending upwards, but the equity positions that people have now are relatively strong. And after all, just being underwater doesn't mean you're going to be forced to sell your homes. This is also very different from what we saw in 2008. I hear a lot of doom and gloomers talk about 2008. Well, then look at the data from 2008. People are taking negative amortization loans. They're taking ninja loans, no income, no jobs, no asset. Most of these loans were subprime loans, when today it seems like only the highly qualified individuals are actually getting loans. So we have completely different buyers between 2008 and today. Now, this isn't to do the old cliche, this time is different. We want to be aware of things that can cause the market to crash. We're going to talk about those in just a moment. But we also have to be able to rule out what's not actually going to cause problems, even though it might be construed as a red flag for the market crashing soon. But before we touch on that, let's explain another reason why people say that the market is going to crash. A lot of individuals point to the high unemployment rate, that we have 7.9% unemployment. This is the highest unemployment we've had since the last crash, and the reality is that the real estate market has to give when unemployment is so high because people can't afford homes, that the homeowner affordability levels are completely out of whack. But unfortunately, this is also not necessarily true. See, in my prior video on the real estate market crash, I talked about the widening wealth gap of individuals. And here's basically how that works. The people who are affected in this pandemic are generally, or at least on a majority basis, the lower earners who increasingly are unemployed due to having worked in retail, hospitality, and entertainment. But the reality is, these are not the buying pool of buyers today. Today, the people buying real estate are generally the higher income earners, the tech engineers, the medical professionals, and those able to work from home. Those are the ones who are frequently able to take advantage of the lower interest rates we have now. They've got the better credit profiles or better income standards, and they're much more easily able to get into the real estate game and be more competitive. So really what we're seeing here is, as usual, the rich getting richer and the poor staying behind. Doomers on YouTube like to average this together. Oh, well, the unemployment rate is so high. Sure, but that's very basic and easy to understand. But when we zoom into the unemployment rate, we kind of see we've got this dual economy. We've got people who are not making it, who are being left behind, and a lot of them were affected by the pandemic. Again, retail, hospitality, entertainment. And then we have the other individuals who, if anything, have seen their income stabilize, solidify, or increase. And they're the ones buying real estate now. So we have this dual economy, and just to look at, one part of the economy and say, that's it, market's gonna crash because of that, it's misleading. The unemployment rate isn't affecting housing right now, and this is exactly why. All right, so now we've got some of this cleaned up in terms of the doom and gloom information, in terms of what's not going to lead the market to crash. Okay, well, what then is actually going to lead the market to crash? First, let's talk about an eviction crisis. Someone recently incorrectly quoted me and said that I used the wrong data. They said that 30 to 40 million people are at risk of eviction. And they said that to compare to what I said. I said that 12 million households were subject to eviction. And this to me is just another example of sensationalizing the statistics. I'm using 12 million households are subject to eviction. Somebody else is using 30 million people are at risk of eviction. We're talking about the same number here with an average of 2.5 to 3 people per household. But anyway, let's talk about the real ways the housing market might decline. Number one, the eviction crisis. Right now, we're approximately $23 billion behind in rent. And a recent Stout housing market report indicates that we will likely be over $30 billion behind in rent as a nation by January. This is a very serious problem. An eviction crisis will lead to more housing inventory on the market, a greater risk of foreclosures by landlords, and a dampening of real estate prices. However, unfortunately, Congress is currently and has been negotiating a housing relief provision in the next stimulus package worth between $50 to $80 billion. If this package passes, the eviction crisis and any potential housing crisis from the pandemic may likely be averted. If this package does not pass, then yes, we have to start being concerned about an eviction crisis. My last estimates were that without a relief package, we may face 10 to 15 million evictions. And remember, those are households getting evicted, not talking about individual people. I'm concerned about housing inventory, so I'm referring to households. And I'm not saying I'm not concerned about people either. I'm just trying to clarify. Anyway, usually 30% of actual eviction filings end up turning into actual evictions because landlords can file an eviction, but then sometimes the tenants leave or they make a deal with the landlord or whatever. So if 30% of 10 to 15 million filings end up being actual evictions, then we'll have around 3 to 4 million actual evictions. And if half of those ended up, which I think that's very high, ended up going on the market because landlords are like, that's it, I'm done being a landlord, you would have 2 million additional homes hitting the market within the span of probably a year, which is honestly a lot. Usually we sell somewhere between 6 to 7 million homes per year. An additional 2 million homes coming on the market on top of a normal year of 7 million homes selling would be like an increase of somewhere around 28% in inventory. That's a lot. Now, it's probably true that our markets right now need that 28% boost in inventory. So it's kind of like, please, let's get some more houses on the market. Though nobody wants to, pray for people to be evicted. That would be bad and wrong. But the point is, there's so much demand right now that even if we had an eviction crisis, and even if half of all of the evictions that went through ended up on the market for sale, there's a good chance that a lot of these properties would just be absorbed into the buying pool. But I do believe that prices would stop skyrocketing. They'd sort of stabilize. So if we're on this scale where we're doing this 10% growth in real estate prices, which is unsustainable, and then we get this flood of new inventory, fine, maybe then we can go back to like 2% growth or something more normal, 2 to 3%, right? That is my expectation. I don't believe, though, that a surge of inventory is suddenly going to cause real estate prices to fall so heavily that the market is going to crash from a real estate eviction crisis alone. And remember, this whole eviction crisis is assuming Congress does not bail out tenants who are behind in rent. If Congress does that, forget the eviction crisis, then it's not happening. Now, what's actually more important, and we've talked about this before, but I want to make this very clear, this is probably the number one biggest risk factor when it comes to a real estate crash. The biggest risk factor is inflation. When inflation goes up, then the Federal Reserve is likely to increase interest rates. And when they do that, real estate prices can suffer very quickly. Now, they don't always go down in the long term, but in the short term, purchasing power gets evaporated when interest rates go up. And that's not very good. So if we see inflation start ticking up more than expected, which we're not seeing right now, then rates might go up and we could see real estate prices come down. If an eviction crisis compounded with premature inflation, that would be bad. That would be a problem because remember, if interest rates go up 1%, what happens to housing prices? They go down 10%, and it's like instant. It's very, very fast. Now, you could still have real estate prices trending upwards. So if real estate prices are trending upwards 5% a year, interest rates go up 1%, yeah, you might see a 5% decline in home prices year over year. So they kind of offset each other, right? If you combine, though, an eviction crisis with premature inflation, that's my opinion of when you could see a catastrophe in the real estate market. So I'm not coming across as somebody who's trying to say like, oh, that's it. The end of the world is around the corner. And I'm also not trying to come across as somebody saying, nope, real estate only goes up. And I'm not doing either of those. I want to take this very middle of the road approach and go, well, I'm not really worried about the unemployment number. I mean, it's a problem for society, but not for housing because we have a different buyer pool looking at housing. I'm not so worried about the, the Case-Shiller home index chart. It doesn't matter because you have to really build in what real estate interest rates have done into that chart. I'm not so worried about mortgage delinquencies because I'm telling you, like, a good chunk of those are optional forbearance plans anyway, and people are sucking that money into the stock market. And I am somewhat worried about the eviction crisis, but the reality is we could see Congress bail out the eviction crisis, and then we don't have an eviction crisis anymore. So to me, the real danger comes to inflation. But at the same time, the European Central Bank just announced that they had their second month in a row of deflation. So we're actually seeing in the world a trend towards deflation, not towards inflation. And every time I mention, we're not seeing much inflation, I get a ton of comments in the comment section of people going, oh, well, have you seen food prices lately? Yes, I have. And there are certain supply shocks that cause prices to go up. But when we look at the overall value of our money, the overall value of our money isn't declining via inflation so heavily at the moment. And until that happens, we're probably not going to see interest rates go up. Keep in mind, the Federal Reserve has instituted a new policy called FATE, Flexible Average Inflation Targeting, and they probably won't raise rates anyway until they've actually seen consistent inflation for a year or two. So most estimates right now suggest we won't see inflation until somewhere around 2024, 25. Some even say this entire decade we could expect low interest rates. So keep this in mind. If you hear drama about the housing market, hopefully this kind of, puts everything into a little bit better perspective for you. As always, check out the amazing courses I have linked down below on real estate investing, do-it-yourself property management. Of course, I've got a YouTube course as well and a sales course and stock course. So check those out. Lots of things down below for you to choose from. Most people, by the way, start with 0 to millionaire real estate investing. You can join the live streams as well. And of course, check out that Deal Machine partnership. I'm really excited for that app. I think it's a brilliant idea. Thank you so much for watching, and folks, we'll see you in the next video.